I'm Ruth George, and this is the Good Life and Legacy podcast, where we explore answers to the questions, how are you creating a great legacy by living well, planning well, and supporting those that you care about? And today I am joined by Dr. Russell James. Dr. Russell James is a renowned authority in philanthropy and estate planning fields. He is an author, researcher, speaker, and well-respected professor and CH Foundation Chair in Personal Financial Planning and the Director of Graduate Studies in Charitable Financial Planning at Texas Tech University. He has been cited in numerous and varied publications and has received many awards. Dr. James has produced an incredible body of work providing insight into planned giving and related matters, which includes his planned giving series and fundraising audiobook series on YouTube with a treasure trove of amazing videos. Dr. James has acquired many different perspectives in estate, tax, and gift planning. He has been a college president and practiced law in estate and gift planning and nonprofit organizations law, along with his many other roles. He is incredibly generous in sharing his discoveries and knowledge to help others. I am extremely honored to have Dr. James with me today. Welcome, Dr. James.
Oh, thank you so much. I'm glad to be here and looking forward to it.
I am so happy you are here. So, Dr. James, your work combines so many fascinating worlds, including behavioral finance, estate and tax planning, and leaving legacies. How did you get to where you are today?
Well, I guess we could start out in law school. And although I went for the purpose of being a litigator, the school that I went to made everybody take tax law their first year. And I ended up just loving it and loving estate tax law, all of that sort of thing. And so after I graduated, I went to work in planned giving for a college. I also was in private practice in estate planning and did that for a number of years. And along the way, would teach some courses at the college and decided that the whole college professor thing is what I really wanted to do. And that's when I went back and got my Ph.D. in consumer economics. My dissertation was on charitable giving, so in the same sort of focus. Then since then, I spent about 5.5 years as college president. So very much at that institution, a fundraising focused role. And since that time, I've really just been focused on teaching and research as a research professor for a number of years at University of Georgia, and now here at Texas Tech University in the financial planning department, where I manage the graduate program in charitable financial planning and have been doing that for about 11 or 12 years now. So that's a little bit of the journey that's led me to take a number of different perspectives on the estate planning and the charitable giving processes.
That is quite some journey. Well, in anticipation of having you here, I really wanted to jump into tax benefits of planned giving. This planning involves transactions that are meant to provide benefits to both the donor and the charitable entity. And on the donor's win column, we have tax benefits that can be layered. Can you give us your general insight into this, and then we'll try to break down different tax concerns?
Oh, sure, absolutely. And one of the things to keep in mind is perhaps the most powerful tax benefit is not the one that you might initially think of. When we think of tax benefits, we think of the charitable deduction. But of course, only about 10% of folks are itemizing anymore, and otherwise they can't use that deduction. So oftentimes the very first tax benefit we begin with is the idea of donating an appreciated asset. If the client has held that for a year or more, then they can donate that asset. They get if they're using a tax deduction, they can get a tax deduction of the full value of that item. But the important part is they get to avoid paying those capital gains taxes that they would have to pay if they sold it and gave the cash. And perhaps the most powerful example is a real simple one. If you have a client who's giving cash and you say, oh, you've got all of these appreciated securities, how about giving those? And the client says, oh, well, yeah, someday, but I really want to hang on to those shares of Apple stock, let's say. And the appropriate response is to say, well, you don't need to change your portfolio at all. You just donate those old shares to the charity and you use that cash you were going to have donated to buy brand new shares of Apple stock. Now, we can actually do this in the same day at the same moment because this is appreciated stock. We don't have that wash sale rule for stock that's gone down in value that would require us to wait. And so this is the initial powerful idea in charitable giving, in tax planning, that we then can leverage in dozens of different ways. So maybe that means we put it into a charitable remainder trust, sell it with no upfront capital gains tax, take income off of it for life, get an upfront income tax deduction as well. And a little bit like an IRA where we don't pay any income taxes until we actually pull that money out of the charitable remainder trust. And lots of other ways that, you know, I take 2 semesters to go through all of the fun things we can do with this. But those are some basic principles that give you the idea of how, as a matter of tax planning, we can leverage a lot of these strategies.
Right. So appreciated property is a big one, and especially considering the estate tax exemptions and where we're at today, as far as that not being usually the biggest concern for people.
That's right. We do still have a lot of estate planning strategies, but those tend to apply to a relatively small share of folks. And so they don't come up as much. You know, when they do, then we still have very powerful techniques. And, you know, all of these strategies, whether it be a charitable lead trust or charitable remainder trust, you know, or even giving appreciated assets for the full value, they've all been discussed as being potentially changed in upcoming tax legislation. You know, we just don't know what's going to happen with that. But if nothing else, if it's something that you or clients are interested in, it's better to act sooner rather than later, going ahead and taking advantage of those things without sort of just assuming that they're always going to be there and be available.
Right. So appreciated property, and that, of course, is the capital gains concern. Can you give us some other examples as far as depreciated property, low basis property, no basis property, and even just some of the examples, i.e. artwork or, you know, a building that's depreciated or something like that, where people's wheels start to turn as far as potentially the assets they have and what can be done?
Sure. So one of the things to keep in mind is if we have an asset that is truly depreciated, that means it's gone down in value. In that situation, the strategy is very simple. We want to sell it, not donate it. Now, if we want to donate, that's fine, but we sell it first and then we donate the cash, because that's a very valuable tax advantage to have that tax loss, which we would actually lose if we donated that property. And believe it or not, I've run into cases where people have done that. They have invested in something that's gone down and down and down, and they sort of never want to admit that they've made a mistake by selling it and taking that loss. And so they'll just get frustrated and donate it. No, that's the worst thing to do. Obviously, we want to sell that asset. We want to take that tax loss. But there's other strategies as well. So for example, we often think of charitable estate planning as something that deals really just with estate taxes, but it can also deal with income taxes. And so here's a couple of different ways that that might happen. One's really obscure. Most people aren't familiar with this, but you can actually donate your personal residence, first or second home, or farmland by a deed through an estate plan. And so that's actually going back to first year of law school in Blackacre. There's this concept of a life estate and a remainder interest deed. And if you donate that remainder interest to a charity, you can actually get an immediate income tax deduction, even though the charity is not going to have full control of that property until after the person's life. And so if you've got somebody who already plans to leave something substantial to a charity, if in their estate plan, and if they want to do it in this way, because it's irrevocable, once you've recorded that retained life estate deed, you can't change your mind. You can take an immediate income tax deduction for that. That's fairly massive. And I say fairly massive because when interest rates are low, and they're still relatively low right now, those tax deductions are very large. For somebody who's 55 years old, they can get over 80% of the full value of that as a tax deduction just for donating the inheritance rights. So to move from the obscure to something that applies to almost everyone, that's dealing with IRAs and 401ks. There's so many clients who think, oh, I don't have that. What is it? 11 million, 22 million. I don't have to worry about taxes, right? Well, actually, they do have to worry about taxes in their estate planning, just not estate taxes. In other words, if they have an IRA or a 401k or any other qualified plan, they've got income taxes that are due. And if the kids or any other heirs inherit that, they're going to have to pay income taxes on it. So the very first asset that we want to donate to charity, if they want to include charity in their estate plans, is that qualified plan money, because any of that money that goes to the charity, there's no income taxes on it. So it's a really important reason why with any clients, we always want to ask the charitable question. Would they like to leave anything to charity in their estate plans? Because once we know the answer to that, then we can pick the most appropriate strategies and the most appropriate assets for them to leave. And notice, it doesn't matter if we're dealing with a client, they may only have $100,000 of assets. We still need to ask that question because, again, of the qualified plan money, the IRA money. And so we can simply list the charity as a beneficiary. It's possible, but really tricky to do it where you list the estate as the beneficiary, and then you can have your estate documents that then leave the money to the charity. You have to be really careful with that. If you don't draft it in exactly the right way, that income in respect of a decedent is going to be taxed to the estate, and you're not going to get that tax advantage. So typically we just say, let's go ahead and just name the charity as the beneficiary for part of that account. A lot of different ways we can do that. And by the way, there's a bit of a misnomer out there that if you put a charity on that IRA or qualified plan account, it could mess up the distribution for the other folks that are getting shares of that account. And actually, that's not the case at all. As long as you pay out the charity their share by the September 15th of the year following the year of the client's death, then it has no effect on any of the payouts for any of the other folks that are receiving part of that account. Mm-hmm. So again, those are some strategies that we like to start with.
Right. So you're looking for the wins on both sides. So for the charity and for the donor. And, it's really interesting when you think about transferring during life, because that's when you're really trying to take advantage of those income tax deductions, of course. And, maybe people just don't even realize that they could do the deed with the retained life estate and the incredible income tax deduction that allows for. And here we are in January of a new year. So we've got great planning opportunities ahead of us. So that's great.
Yeah. And of course, if you have a client who's hit that magic 70 and a half age, that is when they can start doing the qualified charitable distributions. A little bit of confusion on that. 72 is when the required minimum distributions start, but 70 and a half is still when they can start making direct transfers from their IRA or IRA rollover into to the charity. Now that, again, is another fantastic strategy for folks who are not itemizing.
Yeah, I just read today, actually, that because the equity markets are at record levels, that you may want to transfer funds from equities to a money market fund early in the year to prepare for the IRA charitable rollover and perhaps, be able to take advantage of planning early in the year. So any thoughts on that?
Yeah, absolutely. So this is an area that trips people up a lot. And the issue is this. Typically, people will have their money, maybe it's in a 401k or a 403b. Before we do that qualified charitable distribution out to charity, we actually need to move that account into an IRA rollover, because it's only IRAs or IRA rollovers that are allowed to do these qualified charitable distributions. Not a problem. We can do that rollover. Here's the catch. In the year that the person does the rollover, they actually have to pay out any required minimum distributions before they do that rollover. And the way that this catches people is they think, okay, I'm not going to worry about any of this until I'm 72. Well, at that point, it's too late for that first year, because now you're already at that 72 age. You already have required minimum distributions. And when you say, okay, let's roll over my 401k now so I can do this, well, you can roll it over, but before you roll it over, you've actually got to take those required minimum distributions in that year. So I really encourage folks to start talking to your clients about this when they're hitting that 70 and a half age, because number one, that's when they can start making those distributions. Now, they're not forced to take anything out through the required minimum distributions, but they can. And number two, if it's something they think they might do it at some point, go ahead and do that rollover now, so that there's no required minimum distributions. There's going to be no forced distributions from the account through that rollover process. So really good to get started on this around that 70 and a half, not wait until age 72, especially if you have clients who have non-IRA qualified charitable distribution plans that you're going to want to convert to those IRA rollover plans.
Okay. As far as estate tax concerns and taxable estates, so the threshold levels are just so high, and, you know, I may not be having too many clients come to me with those issues, but hey, I'll welcome them. Can you give us your thoughts on taxable estates, and especially, let's say, celebrities? You know, they have taxable estates, and perhaps just sort of the questions that you would use to get them to think about some of these estate plan giving concepts that would allow them to really start planning ahead. Because I think, you know, you've probably noticed, as I have noticed in the papers and the headlines, another celebrity who hasn't done the appropriate planning, and you think, geez, you know, what about at least thinking about the charitable planning that could have been done? And if you can also kind of tie in the low interest rates and how the planning opportunities are that much better given the, you know, the environment that we're in today, and sort of maybe take people through that whole idea of people with these big taxable estates planning with the consideration that we have these incredible low interest rates, and how that could tie into doing some great charitable planning.
Sure. So let me do two things. First, I'll give some law and tax strategies, and then I'm going to take a sharp right turn to talk about some psychology issues when we're having these conversations.
Okay.
So the law and tax side of things is, if we're in that taxable estate, one of the more powerful strategies, if you've got a client who already wants to leave a charitable legacy, already wants to make this kind of an impact, is the charitable lead trust. So how does a charitable lead trust work? Well, the idea is there's actually two kinds. One is a smaller version for income tax planning, but if we're in an estate tax planning situation, the idea is that we take money, we put it into a basket. That basket pays out for typically a fixed number of years, a fixed amount to charity. And then at the end of that 5 or 10 or 20-year period, everything left over goes to whatever heirs or other folks that we have named in that document. Now you look at that plan and you say, okay, but why would I want to do that, right? Why do I want to put this asset into this basket, have it pay out to charity for 10 or 20 years, and then whatever's left over goes to the heirs? Here's why you want to do it. The gift taxes are paid on the amount that is projected to go to the heirs at the end of that, say, 20-year period, okay? We don't actually pay anything on the actual amount that goes to those family members at the end of the 20-year period. Now, if the investments earn more than the initial, what's called Section 7520 interest rate, then all of that extra growth during that full 20-year period, that all is transferred to family, completely estate and gift tax free. The way that these are most commonly set up is that you would set up one of these trusts so that at the end of the 20 years, what's going to be left over for family is just almost exactly nothing, right? Maybe $1 is going to be left over. We calculate that out. And then what do we have? Well, at the beginning, when we set this up, we have to pay gift taxes on that projected amount, which is 0. And then if we are able in those investments over that 20-year period to beat that Section 7520 interest rate, which is still relatively low. We're looking at a 1.6% interest rate right now. If you can do better than 1.6% over that 20-year period, all of that extra growth goes to the family member's estate and gift tax free. And since we've set it up as what's called a zeroed out CLAT, meaning that we're not planning for anything to be left in the end if we only earned 1.6% throughout the life of the trust. If you don't make that much money, well, it doesn't disadvantage the heirs one way or the other. Now, this is a great estate tax planning strategy. That's primarily its only use. This can be done right now when we have low interest rates. It can also be done in the estate plan itself, meaning that if you're going to say, give a certain amount of your estate to charity, why not give it in this way, where instead of just the check going to charity immediately at the end of the decedent's life, we actually spread it out so that the charity will get these payments for the 5 or 10, 15, 20 years, and then the heirs get the extra growth that's left over at the end. Now, let's talk psychology. One of the reasons why that last strategy is so powerful is because it gives the heirs more than one chance at their inheritance. You see, people, when we look at how they deal with inheritance, they kind of oftentimes will deal with inherited money in weird ways. And that means they don't deal with it like any other money that they've earned. They deal with it, they manage it in very strange ways. Partially it's because it's windfall money. It all comes at once, but there's actually a deeper psychological process that takes place there. So it turns out that there's actually an entire field of experimental psychological research that's devoted to the question of how does it change people's values and preferences when you remind them that they're going to die. Now, this field is actually called terror management theory. No, I didn't make that up. Yes, that is a real thing. But because of that, we have hundreds and hundreds of experimental results that give us pretty consistent results that show that personal mortality reminders cause people to have a couple of different responses. Now, that the first response that happens to most people most of the time is avoidance. Just
Right.
I'll deal with that later. You know, that's not doesn't apply to me. Whatever the case might be. The second response has been called the pursuit of symbolic immortality. You might call it lasting social impact. It's the idea that, okay, I understand that I'm going to die, but something that I do is going to make an impact beyond my life. You know, whether that's through my family or my values or my charitable interests, community, whatever it might be, something will live beyond me. Some part of my identity will live beyond me. Now, when we apply this to the way that heirs actually deal with the money, we see both of these behaviors taking place. In the majority of cases, the heirs deal with inheritance money using what I would call an avoidance response. In other words, they spend it very quickly. Think of it this way. Let's suppose that you just had a traumatic event. Your mom has died. and I come and give you a sack of money and say, here's your mom death money. Here's your mom death money you got because your mom died. What did you want to do with your mom death money? And then a few months later, you've still got some of your mom death money there. What do you want to do with the mom death money that you got because your mom died? Okay, I'm intentionally using all these death reminders, but the avoidance response is subconsciously, I want to get away. I want to, I want it to not be constantly reminding me of her death, my mortality. And what we see from national data is, believe it or not, the majority of heirs, they actually have spent the entire inheritance within 18 months. So they're back to their same net worth that they were prior to the inheritance. So they're not spending this money in a normal way. They're not spending it in the way of other money that they've earned or money that they get by other ways. So that's a concern. Now, there's a smaller segment that goes the other direction. And that's the folks that don't spend any of it at all, because that's not my money, that's family money. Okay, now that is taking the symbolic immortality approach, the attraction for permanence, the idea that I am part of something that is lasting and permanent. So from an economic perspective, we would say, well, neither of those are dealing with that money in a normal way. They're either dealing with it using this avoidance strategy, which means it's going to be gone in 18 months, one way or the other, or they're dealing with it in this symbolic immortality strategy of having lasting permanence for the person. Now, I mention this because I've done a wide range of studies of how do we talk to people about estate planning or charitable estate planning. And again, the best phrases take advantage of or consider the effects of these two responses. The avoidance response, I don't want to deal with this right now, or the pursuit of symbolic immortality. I'm very attracted to permanence. So let's think about estate planning for a moment. If you have a wealthy client, what is the most powerful structure that will give them this sense of symbolic immortality in charitable giving? I'll tell you what it is. It's the private family foundation. This is an entity that is named for me. It follows my rules and values. It's legally required to, and it has to do this forever. So yes, I'm going to pass away, but some sense of my identity, my name, my values, my impact is going to continue after I'm no longer here. And that's one of the reasons that we see in national data that the bulk of all charitable estate dollars, they actually go to private family foundations. It's a very powerful technique, powerful strategy. Now, if we're dealing with folks that maybe aren't at that wealth level, other things can become attractive, whether that be endowments, or let's say I'm at a university here, permanent scholarships, endowed professorships. I have one of those wonderful things to have those. But these are all examples of how estate planning can be very attractive because it provides that permanence. Now, how do we deal with avoidance in estate planning? Well, we deal with that if, let's say, we want to get a larger audience. We want to talk to people about estate planning, but not enough people are interested in estate planning. One of the best strategies to do that is to lead with a topic that doesn't lead with death. It's a bit broader topic. So in other words, maybe we want to talk about asset protection, or we want to talk about tax smart giving. And when we talk about tax smart giving, I'm going to talk about some current giving tips, assets rather than income, appreciated assets rather than cash. But I'm also going to mention some estate planning strategies. Any of that IRA money the kids inherit, they're going to have to pay income taxes on it. And notice when I mix those things up, I'm not leading with death. And when I don't lead with death, I'll get a larger audience of people because I don't miss out on those folks that have that avoidance response. In fact, there was a recent study from one of the online will making companies that tested a lot of different phrases in their advertisements, what got people to click on the button to complete a will document. And their best performing phrase was a version of, even if you plan to live to 150, you still need a will. Plan today. Now, notice that phrase, it doesn't lead with death. What does it lead with? It leads with long life. And that's this idea of the underlying psychology in estate planning, where we can be sensitive to these things, at least at the initial stage. Now, once we've got people in the office, they're a captive audience. We can say whatever we want. We don't have to be delicate at that point, because notice what happens if we've got a captive audience and they can't avoid it. We're being very blunt about planning for death. They can't use avoidance. So then they're going to move to pursuit of symbolic immortality. And that's what sophisticated estate planning can do. Even if we've got somebody who's not in an estate tax situation, we say, look, if you don't put any instructions with your money, it may not be used in the way that you want it to be used. Let's go ahead and put some instructions with this. Well, that's taking part of my identity, my values, and it's making it permanent. So again, a little bit of a right turn there for you, but that's some of the psychology in estate planning.
Yeah, it's so many things all wrapped into one. I have been listening to your videos, and I will continue to do so. And I was just wondering, do you have any kind of current statistics as far as charitable lead trusts versus charitable remainder trusts versus charitable gift annuities? Because in your videos, you were saying, let's say the charitable lead trusts were not used as much, but there's a greater amount of wealth in them, and so on and so forth. Do you have anything current as far as the different vehicles that are being used, and of course the family foundation as well?
Right. So here's some things in general. Now, the charitable lead trust, charitable remainder trust data, we're still waiting on the IRS to update that. It's quite a few years old, but here are some general things to keep in mind. As you mentioned, charitable lead trusts are rare. Why are they rare? Well, because this is just typically for folks who are in the estate tax situation. So not going to be that many folks. Whereas charitable remainder trusts, very attractive even for folks who don't have estate tax concerns. However, the charitable lead trusts that are created, they tend to be massive. They tend to be very large. They're from very large estates. And so they will be a multiple size larger than the charitable remainder trusts. Now, a charitable gift annuity, that tends to be at the opposite end of the spectrum. Those tend to be much smaller. A lot of organizations, you can start those at $10,000 a piece. Some are a bit higher than that, but that's just an easy way where I can make a donation, but not worry that I've made too much of a donation that I won't have enough left to live on. And so that can be attractive to folks as well. Go ahead.
Oh, on the charitable gift annuity, do you think it's the income that the donor gets back that's more attractive, or do you think it's the charitable giving, or maybe a little of both?
Yeah, it's a little of both. And this is going to go right back to that same psychology, because I've done some experimental research dealing with annuities in general. And from an economic perspective, financial planning perspective, annuities are actually pretty heavily underutilized in financial plans, even though from a math perspective, it makes a lot of sense. You don't know how long you're going to live. Why not hedge against that? But it's very rare that people will incorporate at least their privately purchased annuities as part of the plan. Now, why is that? Okay, one of the things we know from experimental research is if you ask a person about buying an annuity for themselves, it triggers personal mortality salience. It makes them think about their death. Okay, because what is an annuity? It's essentially a bet on how long it's going to be until you die. And so when people are thinking about annuities, they start to think about their death. So you've got a financial product that makes people think about their death, and it disappears when they do. Okay, that's a very bad combination, because remember, we've got these two responses to death reminders. We've got avoidance. I don't want to deal with that. I don't want to talk about that. And then we've got, well, I want to have some lasting impact that lives beyond me. And so now we've got a financial product that triggers avoidance and it destroys lasting impact because it disappears when that person does. And in fact, we found in experiments that there are some things that you can do when you're talking about annuities that help with that. So for example, very simply, if we describe an annuity using life language rather than death language, people are more interested in purchasing it. So if you say the annuity pays this much a year until you die, people don't want to buy it. But if you say it pays this much a year for as long as you live, people are more interested in buying it. So again, that's the avoidance response. So the less that we are being blunt with the death up front, the less avoidance that we get. Now, the flip side of that is, can we tie an annuity into lasting social impact or symbolic immortality? The charitable gift annuity does just that, because the idea is I get this income for life, and then anything left over goes to this cause that I care about, that's part of my identity, that that will continue to make an impact after I'm gone. So that helps with the issue of the normal annuity that disappears when I do. By the way, in a new research study that I just published with one of my PhD students a few months ago, we found that when you're talking about commercial annuities, you can do this in a couple of different ways. One study that was published about 4 years ago with a different PhD student, we found that people actually, as they're reminded of their death, they prefer annuities that pay them less, but pay their heirs more. In other words, they combine life insurance with an annuity. But we found in this most recent study that you don't actually have to change the product. You can simply reframe the annuity as being a way to protect your inheritance for your heirs against excessive longevity. Now, we haven't changed the financial product at all, but we are reframing the annuity as a way to protect symbolic immortality, as a way to protect that lasting social impact of the rest of your estate that the heirs will be able to inherit. So I think it's a little of both.
Yeah. As far as, I know you mentioned reducing income taxes for heirs or beneficiaries, and thinking about tweaking your estate plan as far as who gets what. And that would be as far as trying to make sure that the income tax owed, as far as retirement assets, wouldn't have to be paid by heirs or beneficiaries. Can you just go over that one more time? Because I think that's really important for people to know as far as an option out there. And, you know, it's sort of a win, another one of those win-win situations.
Yeah, absolutely. So anytime you have a qualified plan, IRA, 401k, 403b, many other different varieties, that's money that you've earned, but you've not paid income taxes on. So a great goal is not the tax deduction, it's the tax avoidance. That if we can avoid paying income taxes on that money, it's actually better than a tax deduction. Why is it better than a tax deduction? Well, because if you get that income, pay the taxes on it, turn around, give it to charity, get a tax deduction, well, your AGI, your adjusted gross income, has gone up. That might increase your payments for Medicare. It might push you out of a range of different tax benefits. And so we prefer not to do that. So anyone who has money in qualified plans can begin to think about, is there a way that I can use that money to reach some of my philanthropic goals? Now, one way to do that is during life. Once we hit that age 70 and a half, we can make those direct transfers. And so we're actually able to pull up to $100,000 a year out of those accounts and make those donations to charity. Now, notice that that client who's at 70 and a half, they're at 71, they don't yet have any required minimum distributions. We can still do $100,000 a year. Now, once that client hits age 72 and they've got those required minimum distributions, these will count against those required minimum distributions, but still it's $100,000. It's the limit. If the RMD is $20,000, they can still make $100,000. If the RMD is $200,000, the limit is still $100,000. Now that amount again counts against the RMD, but it is still $100,000 limit. And then the last piece of planning is who is going to get that money if and when the client passes away. So any of that money that goes to something other than a charity, well, those family members, those heirs, they're going to have to pay income taxes on it. And now with the new Secure Act, they're going to have to pay those income taxes even faster because they got to pull it out within 10 years and pay those income taxes. But any part of that we leave to a charitable, to an exempt organization, completely avoids all of those income taxes. So that's oftentimes one of the most powerful strategies for your everyday clients who are not dealing with estate tax issues, is actually not the goal of let's get the tax deduction. It's actually let's get the tax avoidance. Tax avoidance, much more powerful. And maybe we do that through a qualified plan. Maybe we do that by donating appreciated assets rather than donating cash, because once again, that is not a tax deduction, although it does generate a tax deduction, but for capital gains tax, it is tax avoidance, taxes that we never have to pay.
Right. So it's really looking at all of the assets that you have, the goals that you have, and trying to maximize. So the smartest move is not always to donate cash, but to look at other options where you're maximizing what you can do. Like you said, if you're receiving those required minimum distributions and your AGI goes up and you can't, deduct what you wanted to, that wasn't a smart move. So, it's all these kind of pieces of the puzzle and trying to maximize what's best, as well as keeping in line with your goals. So that's really
Absolutely.
great. So you really talked about giving gifts from wealth as opposed to disposable income. And any other thoughts on sort of missed opportunities to plan from gifts from wealth as opposed to the disposable income? And I know your videos I've watched, and there's just so much in there. I keep going back and listening to them. I feel like it'll take me my lifetime to even figure it all out. But I do think that's such a big point to think about, donating from wealth as opposed to disposable income.
One of the things that we see is that when a person begins to think of their wealth as donation relevant, rather than just their pocket change, their disposable income, it can really change the magnitude of what is possible in their philanthropy. It's one of the reasons why I encourage nonprofits to have these conversations, to educate themselves on this information, because if you can begin to have these conversations that make wealth donation relevant, it actually can be transformational for the size of gifts that donors are going to be interested in doing, in making, to have an impact that they can see. Because again, if a person just thinks of giving as something that comes out of their disposable income, something that comes out of cash, they're going to compare it to other things they spend cash on. What I just spent at Starbucks and other sort of relatively small expenditures. But if we start talking about, say, a gift of appreciated securities, well, my natural reference point is my portfolio. Okay, that's a much larger reference point. So as a matter of behavioral finance, that larger reference point makes the larger gifts feel a bit more affordable, feel a bit more reasonable or plausible. And so it can be really powerful when we're beginning to have these wealth conversations in the context of philanthropy, rather than it just being seen as kind of a pocket change decision.
Right, especially with some of the amazing planning opportunities that we've gone into a bit. As far as the donor experience, I know that's another thing that you talk about, and I always think, God, how do charities figure that out as far as making the donor experience something fantastic that makes them, just so much happier as far as what they've done and feel good about themselves? Any thoughts on that?
Yeah, so I like to think of it in terms of a 3-word cycle. So that 3-word cycle is actually a story cycle. It comes from a story known as the hero's journey, also called the monomyth. And this is a story that begins with the hero's original identity. They then face the call to adventure, which is a challenge. They ultimately win a victory and then come back as a transformed person. They are a hero. They've made an impact. And so they end with an enhanced identity. So if you think of these three steps, identity connects to the challenge, connects to a victory, connects back to an enhanced identity. This story cycle is actually the most powerful model to keep in mind in terms of delivering a donor experience. Now, that challenge, we can think of that as the ask. That's the ask for a gift, for money. Well, we want that ask to relate to their identity. In other words, it needs to connect to their people, their values, their life story, some reason why this ask is important for them, for their story, their community, their people, their values. But what's important is that the story doesn't end there. And that's a real challenge for a lot of charities, that they think the story ends when the donor says yes. But in fact, we have the whole rest of the journey at that point. We've got to be able to show at some point that that gift actually created a victory, that it made a difference in the world. And also that that victory relates to the donor's identity, that they are a wise, impactful, powerful, compassionate, heroic donor. And so we make this connection by finishing the story. Now, that may involve taking some time to report the impact of that particular gift. What difference did it make? It may require taking the time of expressing gratitude for that impact, whether that be the organization itself or other folks involved in that impact, or it might be publicity that shows that other people approve of these kinds of gifts. Now, here's the challenge for charities in doing that. Charities oftentimes are telling stories, but they're not telling the donor's story. They're telling the charity's hero story. And the charity's hero story is a very different story, because in that story, the donor isn't the hero. The donor is just sort of a bit player who shows up for a moment, lays money at the feet of the administrators for their heroic work, and then disappears, right? And then the heroic administrators go on with doing their wonderful heroic tasks. And so the problem is, in terms of the donor's story, that story is not really compelling. It ends at the ask. You never tell me about how my gift made an impact. You're just talking about, oh, well, the organization did this and this and this. Okay, but what did my gift do? Because you were a great organization before, you're a great organization after, but if my gift didn't do anything, then why would I make another one, right? And so there is this story conflict between the donor hero story and the charity administrator hero story that sometimes causes the charity to not finish the donor's story. They don't think about, why do we need to talk about the impact of the donor's gift? We only need to talk about the impact of our organization. They don't think about, why do we need to express gratitude or help others to express gratitude? Because the donor gave us the money to express gratitude to us as charity administrators, because we're so great. And the idea of providing value or publicity to donors, that just makes no sense, because the whole purpose of donors is to provide value to us as the charity administrators, because we're the heroes in this story. Well, that story conflict then leads to this somewhat uninspiring experience for donors, because it's not just that charities aren't particularly effective at delivering that donor experience, it's that they're not even trying, because they're living that administrator hero story that says, hey, as long as we keep being our wonderful selves and keep telling donors how wonderful we are, then that's all we really need to do. Now, if you've ever been in a relationship with another person who has that attitude, you'll know that's not something you won't necessarily want to continue for a long period of time.
Oh, wow. That's really funny. Right. I keep thinking about that, because I think that is a challenge, even for just giving a smaller check, let's say, and you never hear from, let's say, the entity again, and then they're asking you for more money, you go, huh? So I
Well,
think that's a challenge.
yeah, exactly. So think of it this way, Ruth. If you go to a movie and you've got it starts out with a person in their ordinary world, and then some crisis happens, and then a guiding sage comes along and says, "Okay, here is the challenge that we can go on this journey to make a difference," and the main character resists, and then finally they say, "Okay, let's do this," and then the credits roll.
Yeah.
That's the movie that charities are selling to donors. And you can sell it the first time, but you're not going to go back to the director that did a movie that way. They don't finish the story for the donor.
Yeah. Well, that's what you're so important as far as helping, so many people on so many different sides trying to make everything better as far as, plan giving and why you should do it, and what entities should be thinking about to encourage people to make more gifts.
Well, and if you have an organization that focuses on how can we deliver value to the donor, all of a sudden this whole complex world of plan giving, well, it becomes important, because these are great ways to be that guiding sage that delivers valuable ideas and instruments to the donor. So it's really just, in some ways, it's a matter of what kind of a story role is the charity playing in the donor's life.
Yeah. Oh my goodness. As far as your research with the brain scan, can you just talk for a little bit about that?
Sure. So here at Texas Tech, we have the Texas Tech Neuroimaging Institute. And so we've got MRI machines. And some of the research that I've done is we stick people in brain scanners and we have them do their estate planning, believe it or not.
That is so unbelievable. Did you think of that did you just say, let's try this?
Oh, absolutely. So this was part of when I moved from University of Georgia, came to Texas Tech. It was when they were just starting the Neuroimaging Institute. And so these were actually some of the very first brain scanning studies that were run at the Institute, because I'm an estate planning lawyer, right? So these are the questions that I want to know about.
What's the best use of these machines that I can think of? And
exactly.
I love it. Who would have thought of that?
So here are some things that we've, and obviously my focus tends to be on the charitable side of things, but here are some things that have come out from that. One of the things that we've learned is that when people are making that charitable estate decision, we are having them make that decision with regard to a number of different charities and their interest level, and including those charities. And we compare that to the decision-making process when they're, let's just say, writing a check or deciding to volunteer for those same organizations. We see a clear distinction with that charitable estate gift process. And that is where people are actually engaging in visualized autobiography. That is, they're simultaneously activating areas of the brain involved in internal visualization and also taking a self-reflection back on themselves, which these areas simultaneously activate whenever people are mentally traveling back in time, or they're looking at photographs from across their life and they are vividly reliving some of these events. So the donor's life story is actually the key that unlocks the charitable estate gift. In other words, it's not so much a matter of what campaign the charity is in right now or what their next project is. It's, does this cause or organization connect with my life story? And if it does, if it has that connection, if it sort of fits in the final chapter of my autobiography, then it fits in the estate plan. Now, we can take that very sort of esoteric neurological research, and we can actually use it in really practical ways. So for example, after this, in another study, we looked at over 20 different phrases of how do you describe a charitable gift in a will in a way that makes people more interested in making that gift. And one of the most powerful phrases that we found, and you can add this onto any kind of a plan giving instrument, is instead of just asking them about including a gift to charity in my will, we would ask them about including a gift to charity in my will to support causes that have been important in my life. So notice that when we add that phrase on, to support a cause that's been important in my life, what does it do? It triggers life review. Well, what causes have been important in my life? And what we know from the neuroimaging is the more strongly this visualized autobiography is triggered when we talk about a charity, ask about a charity, the more likely the person is to say, yes, I want to include a gift to that organization. And so we can take, again, this sort of neuroimaging stuff and make it very practical. Let me give you another example. In a later study, what we were doing is we weren't just comparing bequest charitable giving to current charitable giving or volunteering. Instead, we were letting people know you will have a legally valid last will and testament mailed to you at the end of this process for free, but you've got to answer the questions while you're in the brain scan. And as they were doing that, then what we did afterwards was to compare a little bit about what happens when they're making decisions about what to leave to family, about what to leave to friends, and about what to leave to charitable organizations. Now, the result that we came up with, not going to be a shock to you, decisions to friends and family member, decisions about gifts to friends and family member more strongly engage brain regions that are associated with memory and emotion. Again, not a shock. Here was the interesting part, though. We then looked at a study to say, I wonder, since the charity decision isn't really triggering much memory and emotion, can we ask about a gift in honor of the family member to trigger that memory and emotion? So in this study, what we did is we first asked them about, what's your interest in leaving a charitable gift to organization X? Okay. They would answer that question. And then we would ask, do you have a family member, either living or deceased, who would have appreciated your support of this organization? If so, think a little bit about that person's connection to the organization. And then we ask them that same question again about their interest in leaving a gift in their will to this organization. And we compare what was the neural signature of the first time they made that decision before the reminder and the second time they made the decision after the reminder. And in that second time, we asked them specifically about making a gift in honor of that family member. And what we find is that the amount of memory and emotion that is attached to that decision the second time goes up dramatically if there is a family member connection. So again, we take this out of the lab, and in another online experiment, one of the things that we find, and this was a couple thousand people involved, is that if you use that same process, it works very powerfully that you can ask somebody about their interest in leaving a gift to a particular organization, and then in their estate plan. But if you then ask them about, do they have a family member who would have appreciated their support of this cause, and then write a little bit about that person's connection to the cause, and then asking them about a gift in honor or memory of that person, if there is that family member connection, it massively increases their interest in leaving that kind of a gift. And in fact, we don't even have to go through that process. There was one of the studies we did showed that for about 1 out of 4 people, it bumps up their interest in including charity in their estate plan if you simply mention this as a possibility. That is the idea of a gift to a charity in honor or memory of a loved one. So it's not a universal solution, but for a lot of people, it triggers a really interesting way for them to leave behind that kind of an impact.
Yeah, there's a real connection you feel to the person continuing to sort of, live on in memory and in tribute and to the causes that they supported. So that makes sense. That's amazing, all the research that you do. I can't even believe the knowledge that you have.
Fun stuff for sure.
It's crazy. As far as advisors trying to help clients with these potential decisions, do you have any kind of process that you would suggest as far as, there's so much to think about, there's the legal technical, and there are decisions that need to be made. And then there is the overall idea of philanthropy and giving. There's determining, what assets you have. And there's just a lot of pieces to the puzzle, and it can get a lot very cumbersome, confusing, and kind of end up doing nothing sometimes. So any kind of ideas as far as following some sort of process or helping advisors with this kind of planning?
So as much as possible, we want to create some form of an external, even artificial deadline. We want to create some reason why it needs to be done now.
Oh, that's really good.
The issue is, and again, this comes back to those same responses of avoidance and symbolic immortality, is that the avoidance response is going to be, I'll get to that later.
Right.
Because if the only motivation for me to do my estate plan is, well, you might get hit by a truck tomorrow, right? The avoidance response says that's not going to be very powerful in terms of a motivation, right? Because I want to avoid that reality. So we need to get clever at coming up with a non-death related reason to plan now, to get the plan done today. Now, if we're talking about our current environment, I might say something along the lines of many of these strategies, they may be disappearing. So we want to get the plan into place right now before things can change. Obviously, some of these instruments that we've talked about, there has been discussion on Capitol Hill of doing away with those instruments. So we want to get it done. Or when we talk about benefit, it might be the peace of mind that comes just from not having to think about all this stuff anymore, just from, having it all 100% done. Let's go ahead so that we don't have to think about it anymore. So now we're actually using avoidance to motivate getting the plan done. You don't want to have to keep thinking about this stuff, do you? Let's go ahead and get this done. And so there's a lot of different ways for charities. We talk about as part of campaigns, they can have goals for revocable planned gifts or a planned estate gifts. That creates a deadline. It creates a reason to do it now. Some charities have actually had magnificent success if they can get another funder to do a matching gift program where they will match, they will give a certain dollar amount for every plan that's completed prior to a certain date. That's another non-death related reason to do it now. Or it might be simply that, we say, look, oh my goodness, these interest rates are going up, up, up. We need to lock in this lower interest rate before it disappears because these change every month. And the longer we wait, the lower the tax benefit's going to be. So let's go ahead and, do whether it would be this charitable lead trust or this retained life estate deed. Let's lock it in now because of these interest rates. But notice what we're not saying is let's get this done now because you might die tomorrow. Right?
Wow.
That's not the motivation. So it's really about being creative at coming up with a non-death related reason to do it now, to make it happen now. Now, again, you're always going to have that percentage of the population that is not in the avoidance stage. They've moved to that second stage and they're ready to plan now. And you don't have to worry about that for that group. But for most people, most of the time, we've got to deal with this avoidance response and come up with some other reason why we need to get it done now.
Yeah, that's really good. I love that because just even in regular old estate planning, when I'm talking regular old, I mean, people who aren't thinking of such creative options for plan giving, it's just maybe getting some basics in place. Oh my gosh, you see the procrastination, So I love that idea.
And in fact, you may even consider using a pricing structure that comes with a benefit of getting it done before this date. And if you wait beyond this time, well, I'm going to have to review all of this stuff again. And so if we pass this date, it's going to get more expensive for you. Now, we're not doing that to penalize the client. We're doing that to give a non-death related reason to get the stuff done now.
That's very creative. That's really cool. I love that. Wow.
I'll have to write that up. We'll come up and then I'm going to test it in the lab with some experiments to see what works.
That's true. Right. Experiment with it. Oh my goodness. Well, I mean, there's literally so many other things that, I could ask you. You are just unbelievably amazing, but I wanted to just ask you some fun stuff. So your daughter, because I listened to so many of your your podcasts and videos, and I listened to one that at the end, I did hear that your daughter is graduating from Texas Tech this year. Is that right?
That's right. She's graduating with mechanical engineering degree in August.
Mechanical engineering.
That's
Oh.
right. You know, probably 2/3 of the majors she could have picked on campus, I could have helped her with, but no, she picked something that like, you know, once you get past calculus, like I don't know what you're doing.
Oh, that's unbelievable. Sounds painful, but amazing. Wow. Well, what advice are you giving her just in general, if you feel like sharing any of that?
You know, it's a funny thing for her right now because she's actually looking at making a bit of a turn in career, going into healthcare, maybe something prosthetics and orthotics. So you know, it's really just about enjoying the journey. That you
Yeah.
know, even if she's going to go on to graduate school, that it's not a matter of, you know, at some point, you know, I'm going to enjoy life. It doesn't really work that way. You need to get
Oh,
skilled at enjoying each day and being proud about the things that you're doing in that particular time at that particular day.
that's the best. Because I know when I was younger, let's say, I always thought, well, once I get this done or that done, you know, maybe I'll be able to kind of calm down a little bit or enjoy things a little bit. So that's the best advice. That's really great. How have you accomplished so much? What's your schedule been like?
Well, I suppose it comes back to the old analogy that, and you may have seen some speaker do this at some point. If you've got big rocks and little rocks and sand, and if you put the sand in first and then the little rocks, then the big rocks won't fit into the container. But if you put the big rocks in first and the other stuff sort of fits around, and that's
Oh,
sort of been my strategy, where for me as a professor, the big rock is trying to get the research and writing done, because it's never the urgent thing. It's never the emergency thing. Students are always the urgent emergency thing, right?
yeah.
But I find if I get that big chunk done, so for me, it actually comes back to, you know, when I was working at a big corporate law firm in Kansas City called Stinson. And, you know, you learned that your time was very much tracked, right? So you had billable hours, you had to spend that. And so I will have a focus on the billable hours that I spend writing and doing research so that I know I
Okay.
get that done first. I try to get that done first thing in the day so that by the time, and I'll get up at ridiculously early time periods to try to get that chunk done. And then when I come into the office and the chaos happens and the classes happen and all of that, at least I've got that chunk done. So that's been helpful for me.
That's a great strategy. So yeah, you really thought about what's going to work for you and you're tackling the big stuff first. That's a really great way to go.
The
Impressive.
difference.
What's one thing you want people to know about you?
You know, so my goal is to help others to encourage generosity.
Mhm.
So that can be folks working at nonprofits, it can be financial advisors, it can be estate planners. And so my focus, whether it is through teaching or writing or sharing videos or whatever it may be, is to help others to encourage generosity. And I think it's important not to lose sight that there is that powerful underlying human value that our work promotes. I mean, I love talking taxes as much as the next person, but these kinds of conversations also
Mhm.
have a deeper meaning, that they can provide that lasting impact for the client, and they can advance this very important value of encouraging generosity. So that's what I do. I am here to try to help other folks be better
Mhm.
at that. So if you want to know something about me, that's what I do. And any way that I can help anyone listening to this with that, I'm happy to do that. And that's why, as you know, Ruth, I share all my stuff for free.
Yes.
You know, all of my videos and papers and slides and all of that, because that's my goal, is to help other people encourage generosity.
And you are succeeding. So
Thank you.
my applause to you. Is there anything you can think of as far as enjoying yourself more that you want to do more of?
I've just really been recently trying to focus on a more narrow focus of having a good day rather than this, okay, I'm going to be panicked because at a certain point, it's all going to calm down and it's all going to be fine. My experience certainly since the pandemic is that I don't ever get to that stage of where it's all going to be fine. And I always have more than it's possible to get done. And so it's really just, can we have this set of experiences in a day where we do some good things, we do some good work, but we also have some other experiences so that we can look back and say, that was a good day. And so that's really the goal for me, where I'm trying to focus more narrowly on stringing together more of those just good days one at a time.
Well, that's right there. Really great. Right. Where you don't panic yourself. Or for me, that means a lot, because I know I've always thought, what have I done today? Or, I didn't do enough, or I don't like what I did there. And being able to have a good day is really wonderful, and stringing more of those together. I love that. Thanks for sharing that. Where can people find you? And I know that you are in many places, and I'll put some links in the video here, but if you want to just share where people can find you, that'd be great.
Sure. Well, the easiest thing for me is if a person would connect with me on LinkedIn, because when you do that, then I will send you all of the everything I've ever done, the videos that you mentioned, the presentations that I've done, the slide decks, the research, law review articles, other things like that. I'll just send you a link to all of those different things. You can kind of pick and choose what might be most relevant in the particular practice or situation that you're in. So that's been kind of my go-to as a way to communicate most easily to folks. Of course, if you're not on LinkedIn, you want to email me, that's fine. I'm sure if you just Google Russell James, Texas Tech, you'll track me down that way, and that works as well.
Oh, wonderful. And is there anything else you want to say before we close?
No, just thanks for having me. This has been great, and really appreciate the opportunity to share.
Well, you are incredible. So thank you so much. I am so impressed with everything, and it'll take me forever to go through all of your stuff, but I just think that you are incredible, and I really thank you for being here. So
thanks so much,
again.
Ruth. Really appreciate it.